All right, let's go ahead and start it.
All yours.
All right, so everybody is pretty much experiencing the same kind of pain, and it's the sticker shock of where the interest rates are going. And especially if you are buying a second home, if you have a client that's buying a second home. Fannie and Freddie have essentially said they don't want second homes on their books, so we're going to make the rates really unattractive. So I have a client that has been looking since January and providing clarity to clients who are nervous about the rising interest rate market. That's really what this is all about. And as I was saying, the client, they started looking in January. The rates were at 4.375, buying a second home. And by the time we got the contract last week, the rate was at 5%, which the client obviously wanted the place, but 5% seemed like a huge jump, and relatively it is. But if you remember that interest rates were right around that back in 2018, 2019. And I've been in the business since 2003. And around 2004, I started following a guy named Barry Habib. And Barry Habib has saved myself and my clients hundreds of thousands of dollars because he just knows the market. And instead of trying to reinvent the wheel, I subscribe to his service. He provides me with morning updates on whether I should be floating rates, locking rates. And I trust him invariably, and he's been right as long as I've been following him. And right now he's talking about a recession coming. And all the indicators are that a recession is coming. And that is what I did for my clients, because in order to make a decision, they needed to be clear about what's going to happen. Her realtor asked me, at 5%, if it can't be lower, what can we do? And I said, well, I want you, based on the advice I get from Barry, I want you to think of this as just one of the transactions that's going to happen. You're getting this 5% interest rate to secure an asset that's going to be appreciating. And we just need to know and some rough estimate of what it's going to look like when the rates go down and why the rates are going to go down. So I actually sent the realtor and the client two videos from so I'm sorry, someone is saying that I do not, let me go backwards here. Someone is saying that you cannot see my screen, so let me see what we can do here. Try to share it again. Hopefully you can see it now.
Yes, we can see it now. Yeah.
Awesome, 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 awesome. Yeah, so I sent the client and the realtor both of these videos, and the one video is about are the rates going down soon, and the other one, this one, is why they're going down, and Barry backs them up with charts and graphs to show that somewhere in the end of this year or 2023, the rates are going to go down, and he thinks they're going to get back down there into the low threes. So what I did was essentially present a snapshot with some guidelines in it. The very conservative numbers that he's saying is that 6 months to 18 months, there is going to be a improvement in rates. And so what I did was the client had 4.375 in their head. So 4.375 I was using as a worst case scenario, and I was using 3.75 as the best case scenario. And I used 4% appreciation, and I also used the 5-year window. Why did I use the 5-year window? Because people are doing something with their mortgage every 4 to 7 years. Normally, since the crash in 2008, 2009, and COVID, it's more like 4 to 9 years. but 5 years is a good snapshot. And I wanted to provide clarity for my client to say, hey, there's going to be a window between 6 months and 18 months from the time you make your first payment. She's closing on April 29th of this year. So her first payment is going to be June 1st, which means 6 months from there is December 31st, December 30th, which is what I use in these slides. So let me, I have a software that's a little more elaborate than this, but I wanted to keep it simple for you so you could follow. So she's doing a 7-year ARM, which gives plenty of time to be able to refinance. Again, most people are doing something with their mortgage every 4 to 7 years. The sale price is $515, loan amount $412. The total payment $2813.21. The closing costs and the escrow balance. I include the escrow balance in there because it weighs in on my calculations. So this is the snapshot, and at the bottom you see the net worth. And I'll get to why I include the net worth, because that's kind of the guide that I also use when I'm advising the client to let them know that it's still a good time to purchase. So 6 months out, on the 30th of December this year, and I use Barry Habib's tools and his to project out based on the county what the value of the home is going to be. So there's good if it's 6 months, which is when he expects the rates to start improving, and if it gets to 4.375, what that payment looks like. And obviously, when you refinance, there is a cost to that. And some people that do what I do may use a different calculation, but as a finance major, I'm about the present value of money. And yeah, the gross closing costs, because of the escrows and the reissuing of title insurance, the transaction costs gross would be $8,000, but there's usually an escrow balance that gets returned from the loan when we started it. And then there's also a skip payment when you refinance. So I like to show the net transaction cost, because that's real money. That $3,909 and the $2,813, that is real money that is going to stay or be put back into my client's pocket. And the difference in the payment of 4.375 versus the 5% in the ARM is $129 a month. So the break even is 11 months. When I do refinances, a general guide is that you want to recoup the cost within 36 months. Why 36 months? Because most people are doing something with their mortgage every 4 to 7 years, whether it's buying a new home, pulling out some equity to buy an investment property. There's so many different reasons, but people they're not in a 30-year fix. We do 30-year fix because it's usually the lowest payment right now. In this situation, because Fannie said we don't want 30-year fix, the ARM was a better option at the time. 6 months out, the 30 years should be back in line. We'll refinance her. That's the quickest I project for the client that we're gonna be able to refinance her, and the break even is 11 months. Now, the bottom part there, I did a calculation because I was asked by the client and their realtor, what was the opportunity cost lost mentally? Because the 4.375 was, you can't lock until you have a contract. But in her head, she had that 4.375. So I did the calculation. If she had a 4.375 now, how much that has cost her in the time that we refinance. And in 6 months, the cost was $2,335 $927 over the 6 month period of a higher payment. And if you add that to the net transaction cost, you have $2,335. So the break, even with the opportunity cost, she would be able to catch up within 18 months, which is well within that 36 month window that I was talking about, when it makes it worth it to do a refinance. And then with the net worth, everybody has their different pain points. I did a calculation in my software, and it showed that by refinancing in 6 months, she would be paying less principal and more principal and less interest by doing this refinance transaction. So that makes it a little easier to say, all right, well, this 5%, this is just a temporary paying to secure this asset that is going to be appreciating every month, every year. Let's see what happens with the market based on what Bear Habib says. And 6 months was the soonest, and I had 4.375. But what if the rates really drop fast and it dropped to 3.75? Then you'll see, using the same calculations, that her break even is 5 months, and the opportunity cost break even is 8 months, which again is well within reason. Now, if she was concerned with her net worth, you see here it says 277,720. Going back to the previous, the 4.375. I'm sorry. There is if she were to pay an extra $74 with this new payment, she would be able to equal what her net worth is, because it was just a little less than, let me show you, 278,860 was the net worth in the transaction that we are doing right now. With the 6 months out, it was just a little less, 277,000. So if net worth is what was important to her, all she would have to do is pay an extra $74 a month with that savings to be able to break even. And you see, and that's because she's going to be saving a little bit more with that lower interest rate. Now, worst case scenario window, 18 months out, what does that look like at 4.375 and 3.75? Break even would be 9 months if we waited till the 18 months out, which would be December of 2023. December of 2023, 9 months out, you're looking at a break even in November of 2024. The opportunity cost break even 26 months. That's the highest out of all the calculations I did, still under the 36-month threshold I'd like to use as a guideline. And she's made whole by April of 2026. And with the net worth, you see that her net worth is already going to be higher because the house is appreciated. More of 18 months and about where they were in 2019. I had a client who was he was buying a house. I did this exact same calculation for him. No, in 2020, we refinanced him into a 2.875 30-year fixed. And that's essentially what I'm going to do. This every day, Barry reaches out. We have a morning update. There's hourlies on what's going on in the market. When I start seeing it get that second home interest rate getting down into the mid fours, I'll start having a conversation with this client, and we'll talk about when's the time to refinance based on Barry's advice. And the goal obviously would be to get to 3.75. But you can't look into the future, but just providing this calculation for the client gave them the confidence and the sense of security that 5%, although it was higher than what they expected, it was still worth moving forward. So that's it. If there's any questions about this, I know I was throwing a lot of numbers out there. If you wanted me to do a calculation on any specific scenario, I'm always available for that. And if there are no questions, you can always reach out to me at 814-777-0757 or email me at ba@collab-lending. I really appreciate your time, and I'm always available to you. Have a fantastic day and a fantastic week.